Hello, everyone. Welcome to National Management Service. As a Gokul, I'm working as an assistant professor in the Department of Historical Business Administration, State Montevideo Institute of Technology. Today, we begin to in investment and capital budgeting decisions. In Unit 1, we covered the foundation of national investment, including key decisions, time value of money, and valuation concepts. Now, we move into one of the most critical areas of financial management, how the firm decide where to invest in their long-term capital. This unit will span multiple points, and today in part one, we will establish the foundation by understanding what capital density is, why it matters, and how it shapes a company future. In this first part, we will cover the definition of budget and capital budgeting, key features and significance of capital budgeting, process, importance, and benefits of capital budgeting. Let's begin with some basic definitions. What is budget? Simply put, a budget is a financial plan that outlines expected revenue and planned expenses over a specific period. It's a management tool for planning and controlling future activity. Think of it as a roadmap for your finances, whether for your household, a business, or a government. It helps answer questions like how much will be here, how much can we spend, where should we save on. In business, budget guide savings, borrowing, and spending decisions to ensure resources are used efficiently. Then capital budget. Now let's build on this. Capital refers to the operating assets used in production like machinery, buildings, and agreements. A budget is a plan cash flows. So capital budgeting is the process of analyzing potential major investments or projects and deciding which one to include in the company's capital budget. Let's look at some definitions from experts. Charles T. Green says capital budgeting is a long-term plan for making and financing proposed capital outlays. And Lynch defined it as planning development of available capital for the purpose of maximizing the long-term profitability of the concern. Then key features of capital budgeting according to Oster Young include potentially large anticipated benefits, a relatively high degree of risk, a relatively long period time between initial investment and expected return. Capital budgeting decisions typically involve large sum of money have long-term implication, which means beyond 1 year and are not easily reversed. Significance of capital budgeting. Why is capital budgeting so significant? Let's break it down. First point, resource utilization. The success or failure of a business largely depends on how well it uses its available resources. Then key financial tool. It's a main tool of financial management that helps allocate capital efficiently. Then risk and uncertainty. Capital investment are exposed to future uncertainties, market condition, technology changes, etc. Irreversibility. Once funds are committed to a long-term project, reversing the decision is difficult and costly. Then next one, capital rationing. When funds are limited, capital budget helps evaluate and select the most viable projects. Then cost control. It provides a framework for controlling cost of expend capital expenditure projects and last avoiding extremes. It helps management avoid both overinvestment, which means if we are going for the overinvestment means we are wasting some resources and underinvestment we are missing some growth opportunities. The importance and benefits of capital budgeting. Let's summarize why capital budgeting deserves such attention. Growth drives business expansion and long-term growth. Second, large amount. It involves substantial financial commitment. Third, irreversibility. Difficult to undo once implemented. And fourth, the complexity requires careful analysis of multiple factors. Then risk exposed to future uncertainties. And then last point, long-term implication. It affects the company for years to come. These factors make capital budgeting one of the most strategic decisions a finance manager makes. Then benefits. What do company gain from systematic capital budgeting? Forecast return. It helps evaluate proposed projects to forecast expected return. Second, adequacy check determines whether the returns are adequate given the risk involved. The third, long-term perspective evaluates decisions that involve current cash outflows but generate benefits over multiple years. In essence, capital budgeting ensures that today's investment create tomorrow's value. Then we will see the process of capital budgeting. The capital budgeting process typically follow these steps. First step, project identification. Second, project screening. Third, project evaluation. Fourth, project selection. Fifth, implementation. Sixth, performance. Let's see about each steps in some detail. Project identification, it usually recognize the investment opportunities of the company, which means like capital budgeting, where we are getting the money like from the banks or financial institutions or from the shareholders or they are spending their own money like that. They have to uh, collect the capital and they have to identify the project for which their money can source or for which their project can be done. Then project screening, preliminary evaluation to filter unviable ideas. Third, project evaluation. It details the analysis using techniques like NPV, IR. NPV means net present value, IR means internal rate of return. Then project selection. It chooses the best projects based on the evaluation. Then implementation. Bring the selected project into action. Then performance. It monitors actual results against projection. This structured approach ensures disciplined decision making. That's a wrap up of part one of Unit 2. We have laid the groundwork by understanding what capital budgeting is, why it's significant, and how it benefits organizations. In part two, we will explore different types of capital budgeting projects and factors that increase these decisions. If you found this video improvements, please like, share, subscribe. If you have any questions, please drop your question in the comments. See you in the next part. Thank you.